This is Trading Techniques Lecture number 544. Last time we began a detailed study of the new indexes and applications that were introduced in the booklet, How to Select a Stock. Our discussion in Trading Techniques 543 focused on the new weekly barometer indexes. In this tape, we will move on to an investigation of the OP, Force, and Technometer indexes of the 8 stocks that make up the Wyckoff wave. If time permits, we will also consider how all this new information can be combined with what has been available for many years in an orderly and constructive plan of operation. If time does not permit, and it may not due to the volume of material that needs to be covered first, this last topic will be taken up on the next tape. Our starting point will be with some explanations and a few warnings about these new indexes. Some of this material was covered in How to Select a Stock, but in less detail. Understanding what these new indexes are and are not is critical to success in using them. We begin with the basic assumption that no stock is a market unto itself. This is true even of stocks like General Motors, Exxon, and IBM, which are often considered the primary stocks and given a bigger-than-life status. These and all others are only small portions of a much broader market, and all of them are subject to the action of that market. This idea may be the most difficult of those that are presented for some to accept. This is likely because of the well-known fact that there are always some issues that seem to do quite well at bucking the trend. This does not mean, however, that these stocks are not subject to the various pushings and pullings of the general market. It only indicates how they have responded. To get a better mental image of the validity of this idea, think of an individual stock as being an unusually strong man in the midst of a crowd of people, all of whom are intent on going in the opposite direction. None of the individuals in the crowd may be as strong as the man that stands for the stock, but together they are an extremely powerful force. Depending on his absolute level of strength, the strong man may only be able to stand his ground against the oncoming mass, or he may be able to make a few steps in his desired direction, only to be pushed back somewhat with the next surge of the crowd. The man will be able to push his way through the crowd in such a way that an observer may feel that the crowd was only imaginary. Of course, the energy expended by the man during such an effort would prove this not to be true. We see this same type of thing in the market on a regular basis. Here, the crowd is the thrust of the market's volume, either on the upside or the downside. The strong man is a stock that we would call relatively strong or weak. There are many instances on an intraday basis where a stock will make a good gain or decline, perhaps something along the lines of half a point, and then hold all or nearly all of the gain or loss on the next intraday wave when the thrust of the volume is being reversed. This tells us that the volume being traded during this period is being absorbed, which is very positive. An indication for those who want to see the stock make progress in the opposite direction. Consequently, when the thrust of the volume again reverses, this stock is very well positioned to add to its progress. Even if a stock makes no move and trades no volume when the thrust of the market is reversed, it is still exhibiting that it is subject to the market, because if it was not, the price, progress, and flow of the volume would go on uninterrupted. In addition to being able to observe that this assumption is valid, we also have confirmation from the master himself. Get out your text or basic lecture number 1 and review the 5 steps of the Wyckoff method. You will note, as we have discussed in the past, that 3 of them, that 60%, are primarily or substantially concerned with the general market. Mr. Wyckoff would not have emphasized the impact of the general market so much if it was not truly important. For those who still have doubt about this assumption, try to get access to an intraday data for a day and make your own study. It could prove to be an enlightening experience. The next thing we need to do is consider some of the mechanics and construction of the various indexes. This is important for 2 reasons. One is simply that it will lead to a better understanding. The other, and more important reason, is that the extra knowledge should help avoid some crucial errors in application. In developing the OPs for the 8-wave stocks, the same concept as applies to the OP of the general market has been used. That is, that volume during up waves is added to the indexes, and volume during down waves is subtracted from the indexes. There has, however, been a change in the number of shares represented by 1 point. For the general market OP, a volume of 1 million shares equals 1 point. With the individual stocks, the amount of volume equaling 1 point has been set at 10,000 shares. What this does is to make the importance of 10,000 shares in the index of a stock that trades 500,000 shares a day the same as 1 million shares is to a market that trades 50 million shares per day. This makes working with the high volume stocks, which should be Exxon, IBM, and General Motors, a simple matter. There is a potential problem, however, with some of the others where the volume is substantially lower. In working with the OPs of the lower volume stocks, we are presented with two options. The first is to adjust the number of shares set to equal 1 point on a stock by stock basis based on the general or average volume of the stock. There is nothing especially wrong with this approach, but it does seem to be a bit impractical. It is possible that the result could be 8 OPs, each constructed in a different way. It would be a bother to remember each of these different constructions, and if one were forgotten for a period of time, resulting in an incorrectly posted chart, the outcome could be a disaster. The second option, and the one we have chosen to use, is to adjust the scale of the charts of the various OPs. In this way, the smaller day-to-day changes that seem to be the case with the lower volume stocks can be given the relative importance they deserve by simply expanding the scale. Contracting the scales of the heavier traded stocks will help keep relatively insignificant moves from taking on undue importance. The selection of the actual scale for each stock's OP is something of a trial and error process based on the range of values recorded over a reasonable period of time. The set of charts that accompany this tape seem to us to represent the best scales for present conditions. The level of volume also has a major impact on the force indexes of the various stocks. Here, it is not so much the scale in which the data is posted that is important, although this is a minor factor, but it is the differences in the absolute values that count. This is because of our normal procedure of comparing the behavior of one stock to that of others. We should do this, but greater care is going to be required so that important errors in interpretation are not made. In constructing the force indexes, we have followed the same procedure as was the case with the OPs, and assigned the same importance to 10,000 shares as we did to 1 million shares for the general market. This was done to make the data easier to work with. The ability of the force index of the general market to move above or below the zero line is directly affected by the level of volume. As the average level of trading increases, so also does the extremes to which the force index can go. The number of shares traded in the individual stocks has a similar effect on the force indexes of the various stocks. The indexes of those stocks that regularly trade hundreds of thousands of shares will be subject to greater extremes than will those of the stocks that generally trade only in the tens of thousands. What this means is that the force indexes of stocks such as Exxon, General Motors, and IBM should be subject to more direct comparison to the force of the general market. Exxon, for example, with its average daily volume currently running well in excess of 500,000 shares per day, may even show greater extremes on its force index than does that of the general market. The other stocks with their consistently lower volumes will have less volatile force indexes. The effect of the differences in volume on the various force indexes presents potential for errors in interpretation. When we look at the force index of the general market, we generally conclude that readings of negative 32 up to 0 and into the positive range are a positive factor. They tend to represent more of an upward pull than a downward push. At the other extreme, we usually look upon readings below negative 64, and especially those below negative 80, as being a very negative factor. They represent substantially more downward push than upward pull. When we consider the force indexes of the individual stocks, however, these extremes do not apply. They would only hold true for a stock that consistently trades a volume that is very close to 1% of the volume traded by the general market. Our chances of finding such a stock are very small. The high-volume stocks in the wave are likely to have upside and downside extremes that at least equal those of the general market, and in many cases may exceed it. The low-volume stocks will never even come close to equaling the extremes of the general market force. What this means is that we cannot make a direct comparison between the force of a stock like Exxon and one like Union Carbide. It just will not produce any useful information due to the character of its volume. Exxon is subject to force readings of as much as 200 below zero. For a stock like Union Carbide, this type of reading is virtually impossible to achieve. Exxon, with a force of minus 100, may be under only a moderate level of downside pressure. Union Carbide, on the other hand, with a force of only minus 32, may be under tremendous downside pressure. This is a very important point. Do not attempt to relate or compare the absolute values of one stock's force index to that of another, or to the general market. If we cannot make direct comparisons of force indexes, can they possibly be of any value? The answer is yes. There are at least two important ways in which they can be useful. One is in measuring the amount of upward pull or downward push being applied to the stock, which is the purpose for which the concept of the force index was created in the first place. Since we have already discovered that we cannot set an all-inclusive range of values to represent small, moderate, or extreme amounts of pressure or pull, it is necessary to determine these levels or ranges for each individual stock. The only way to gain this knowledge is by studying and observing the indexes over time. The other important way in which the force index of the individual stocks can be useful is in measuring important shifts in the sentiment of investors. In this, the force indexes of the stocks can be compared to one another and to the general market, because what matters here is not the absolute values, but rather the flow of those values. If you have made any type of study of the force index, you have no doubt noticed that it tends to move in a wave-like pattern. Somewhat closer examination will show that the crests and troughs of the successive waves tend to move up and down with regularity. The points where the market is unable to make higher crests or lower troughs are especially important because they indicate shifts from a bullish to a bearish, or from a bearish to a bullish sentiment. When these occur, the investor is well advised to sit up and take notice, especially if he happens to be holding positions that are contrary to the shift in sentiment, but also if an opportunity to take a position is being sought. The same type of thing happens with the force indexes of the individual stocks. In these cases, however, the effect may be more dramatic. If the general market has been showing a bullish sentiment, and then there was a shift to the bearish side, we would know that in general we had better get out of the long side and think about getting onto the short side. However, we also know that all the stocks on the exchange seldom move in mass. Therefore, a general shift in sentiment may not necessitate an immediate change in a particular position that we may be holding. On the other hand, by the time the general shift becomes apparent, it may be too late for a position we are holding. With the force indexes of the individual stocks, this is not likely to be as much of a problem. because the index is providing an indication about that stock only. Therefore, its indications should be taken very seriously, but that does not mean mechanically. Don't feel that as soon as a shift in sentiment is observed in a particular stock, that you automatically have to shift sides in that stock. It is almost never justifiable to go from being long in a stock to being short, or from being short to long in a single breath. Things just don't happen that fast in the market. We still need to pay attention to whether the stock is in a rally or reaction, what its potential is, and its exact position within the trend. These will help determine the exact time that action is warranted. Now, we can move on to the technometers, and here again we have a volume-oriented set of indexes. But this time the absolute levels of those volumes is not a factor. Therefore, movement in these indexes can be compared directly to each other and to that of the general market. This should make working with the technometers a bit easier. The fact that these indexes should be easier to interpret than the force indexes should not be taken to mean that nothing is different. There are a couple of important differences that should be noted to help avoid being drawn into premature action. Over the years, we have come to realize that when it comes to the technometer of the general market, the 50 level and the 38 level have special significance. At 50, it is felt that the technometer is giving a clearly overbought indication, and that at 38, the indication is one of being clearly oversold. These numbers are not magic, but they have proven to be reliable guidelines. With the technometers of the individual stocks, there are also guidelines, but they are a little different from those of the general market. On the oversold side, it appears as though the 38 level is a valid indication of being oversold for the individual stocks, as well as for the general market. We do notice, however, that readings below the 38 level seem to be more common with the stocks than with the general market. Therefore, instead of looking at one particular level as being the oversold indication, it would be better to look at readings between 36 and 38 as being oversold, with the dangerously oversold range continuing down from there. On the overbought side, the 50 level does seem to indicate a degree of being overbought, but not as decisively as with the general market. There are numerous occasions when the technometers of the individual stocks soar to 55 and even beyond. Therefore, we will take the area between 50 and 55 to be the overbought region, with readings above 55 indicating a dangerously overbought condition. When working with either the overbought or the oversold extreme, the most important thing is to avoid purely mechanical applications. They are a trap that is very easy to fall in. The reason is that sometimes the mechanical applications work. Occasionally they even work for prolonged periods of time. The problem is that at least once in a while a mechanical application will fail, and if you happen to be relying exclusively on it, chances are you will be unwilling or unable to make the necessary corrective action before the situation turns into a disaster. As we have seen, the figure chart indications are a help in deciding when to take action. Now, having laid the foundation for our study of the individual stocks, we are just about ready to turn to the charts. But before we do, this would seem to be a good place to insert some comments on the availability of these charts. A number of those who have been following the data since the beginning of January have asked when the new indexes will start appearing in the charting service. Unfortunately, it will probably not be possible to put them there. The reason is simply a space problem. Although our charts are bigger than anyone else's as far as we know, there is still only a limited amount of space on each page. Generally, the figure chart takes up from a quarter to a third of the space at the top of the page. The volume can take up almost as much space at the bottom of the page, and that leaves only about half the page in which to try to fit the price action, the OP, the force, and the technometer. There is just not enough space for so much data. It has also been requested that we include the data on the printed version of the Pulse of the Market. Here again there is a rather critical space problem. At this point, just about every inch of those 4 pages is consumed with data or graphics. It is possible that something currently being included could be dropped in favor of the new indexes. However, at this point, we really do not know how many people will be using the indexes, so it is a bit premature to start tampering with an established and accepted format. For now, the data and the charts of the new indexes will remain somewhat limited in availability. The data will continue to be on each day's recorded update, and the charts will be used in these discussions from time to time, and in the trends and trading ranges and trend letter publications on a regular basis. The charts included with this tape should get you started. They each cover the last 3 months' action and provide room for the action of the next 6 months. This should be sufficient for any short-term analysis and a great deal of intermediate analysis. As your chart history grows, the possibility of longer-term analysis will become more real. Between now and then, the unfolding picture can be used as a learning experience. Jumping directly into actual market operations without such a learning process would not be a wise course of action. Okay, now we can move on to the individual stocks, and we will begin with Exxon. Of the stocks in the wave, Exxon has probably been running the highest average daily volume during the past few months. Therefore, we have reason to expect an especially volatile 4th index for this stock, and the chart indicates this to be true. The recent low of more than negative 240 is much lower than the general market force has ever managed to go. We are likely justified in concluding that this stock is under incredible downside pressure. This is a good reason to hold off any buying in spite of the 10% return currently available in this stock. It would be much better to let the large interest soak up the supply and buy later when there is some reason to believe the stock is about to move. A 10% return is much more profitable in a stock that is moving up than it is in one that is just laying there. There is another point which should be noted about the force of Exxon. The downward pressure on the stock during the past 3 months has come in 3 waves. Each of these has brought an increased amount of pressure over the previous ones. It can also be seen that during the 2 periods of relaxed pressure that have come between the downward bulges, the amount of upward pull has deteriorated. When these facts are combined to form a conclusion, it has to be that the stock is currently, and has been for quite some time, the object of very negative investor sentiment. Therefore, we are provided with another reason to be cautious about considering this stock for the long side right now. There is yet another observation that can be made from the 4th index of Exxon, but to do it we will have to also consider the progress of the price. Notice that the first episode of downward pressure came while the stock was advancing. It probably was a contributing factor in the stopping of that rally. Next, notice that the second downward thrust in the 4th, which was substantially larger than the first, appears to have helped produce the 2-point decline during this period. So far, this is a logical progression of events. The first thrust stopped the move already in progress, and the second and larger thrust turned the price around. Now let's consider the third thrust. Obviously, this one was larger than either of the other 2. From what we have already seen, it would be reasonable to expect that the increased pressure would bring an increased result. Did that in fact happen? The answer is no. During the second thrust of downward pressure, the price dropped from 33 almost to 30. When the pressure was relaxed, the price recovered to 31 3/8. The next thrust took the price down to 29.5, which represented a somewhat smaller result. It also meant that the amount of new downside progress made was less. This suggests that the bulk of the damage had already been done. We cannot justifiably use this as a reason to go out and make large commitments on the long side, but we should use it as a reason to pay special attention to the next downward thrust. If it happens to indicate a still greater amount of downward pressure, but the price is unable to make any new downside progress, we would be witnessing the beginnings of a potentially important change in the character of this stock. The same will be true if the next thrust of downward force is less than the last. This would represent a rather clear-cut shift in investor sentiment. As we move down the page, the next index we come to is the Techno Meter, and here there are also a few observations worth making. The first is that, at least during the past 3 months, a reading of 38 has not been enough to really turn the price upward or stop its decline. In this case, that area of an oversold range between 36 and 38 seems to be more important. This area was reached after both the second and third thrusts of downward pressure, and both times the result was a rally. At this point, both rallies appear to be of about the same magnitude, but notice that the second one has produced a penetration of the supply line. This makes it more important and provides another indication that a change may be underway in this stock. Some students have difficulty interpreting the barometer indexes. This is especially true for the general market, where there are 3 variables with which to contend. Since we are only working with 2 indexes on the individual stocks, the learning process should be somewhat easier. While it is going on, there is another set of relationships that can be utilized, which most people find much easier to understand. These arise from a comparison of the Wyckoff wave and OP action. What we are looking for are divergences and instances of inharmonious action, both of which are indicators of impending change. The Exxon chart shows one good example of both divergent and inharmonious action. The divergence came during the rally to 33. It is an obvious example. The price was making upside progress that was not being supported by the volume, which is a situation almost certainly doomed to failure. It is interesting to note that this rally occurred during a period of wild speculation about the future of oil prices. The speculation was that they were going to start marching upward again. The chart indicates that the general public was caught up by the news. It also indicates that those who knew better used the opportunity to unload a large number of shares. This is just one more in an endless string of examples of why the news should be ignored. The example of inharmonious action can be found in developments during the last 2 weeks of the chart. There is a sharp drop in the OP that brings out only a small decline in price. In other words, there is a tremendous effort with little result, which is indicative of a change. This indication fits in with the others already mentioned. The overall effect tells us to pay more attention to this stock. Now, let's move on to General Electric, where we will again find several rather clear indications. We will begin with the OP wave relationship. The first important divergence developed when the price was attempting to negotiate the 60 level for the first time. There was an obvious excess of upside effort, resulting in a classic type of divergence. The response of the price was to decline to the 57 level. As obvious as this divergence was, however, the next one was even more obvious. While the price made virtually no progress, the OP came roaring back and made a new high about the end of the year. When the response to this imbalance came, it was in the form of a further retreat in the price to the 55 level. When the price of GE reached 55, something else happened. Notice that points A and B have been marked on both the price and OP. This also was a divergence, again indicating the likelihood of an impending change, which has occurred. The magnitude of the divergence between points A and B is greater than the other two, and the stock appears to have responded accordingly by making up the ground it took 2 divergences to lose, and doing so in about half as much time. The fourth index of General Electric indicates that, like Exxon, it also has been the object of negative sentiment recently. Notice that through the last downward push there is a pattern of lower tops and bottoms. This pattern may be changing, however. The last posting on the chart represents a higher high than at the previous peak, It is only a slight new high, so we should wait for some confirmation before drawing any conclusions. If that confirmation comes, we could be seeing an important change in this stock. Continuing in alphabetical order, the next stock in the wave is General Motors.
At this point, the tape for the trading lecture became mumbled, so I would like to finish a few of the individual stock charts that they discussed. So at General Motors, the OP you can see rallied to new highs into late January, while the price of General Motors traded sideways between 38 and 39. This led to a decline down to the 34 level quickly, and then the markets became oversold and rallied again from there. The next chart we want to look at is IBM. IBM, you can see the divergence between the price and the OP. It's marked AB. You can see that the OP had a nice sell-off coming down to B, while the price of IBM was trading sideways between 56 and 57. And this led to a sharp rally out of this congestion area. The next stock we want to look at is Merrill Lynch. Bringing up the chart of Merrill Lynch, you can see in early December, once again, the OP goes to a new high. Markets are overbought on the technometer. Price is struggling to rally. And then from there, the price of Merrill Lynch proceeded to stair-step lower for the next month. And then finally, the last chart, Pittston would show the same thing with the OP going to new highs, technometer being overbought. The price is trading sideways, not willing to respond to the buying from the OP. And then the stock starts a aggressive downtrend line shown by the price falling from 28, 29, clear down to the 19 level. So that kind of wraps up the individual stock charts on this trading lecture, and we will go to the next. Thank you.